And
good afternoon, everyone. Before we can start, we have a new victor. Good.
yes, we do have a new victor.
Yeah, ne. You can even see. I even added a new a photo so that you guys don't forget me. That's me there back there. With the hair and now with no hair. So that you can recognize and spot the difference.
All right, happiness. Let's get the show on the road. Ladies and gentlemen, welcome to the second edition of day 2 of the Youth Entrepreneurship Network webinar series. Today's topic is real estate finance and funding models. And today we are joined by a brilliant panel from across Africa. We are starting with Mr. Kojo, who is from Ghana. Then we are joined by Bush Victor, who's from Botswana, and we are joined by Mr. Tsietsi Matonsela, who's a South African professional who is currently joining us. Without further ado, I'm going to pass over to our moderator, Zandile, who will take over and lead us through the session for today. Zandile, you may take over. Thank you.
Thank you so much, Albert. Good evening, everyone. As introduced, I am Zandile Ntlogwana, and I will be your moderator this evening. I will be steering this wonderful ship. I don't know if I am the rose amongst the thorns or I am the thorn amongst the roses because my panel is all male. But I'd prefer to be the rose still, if that's
the
allowable.
first one is the correct one.
So yeah, good evening to everybody, and thank you so much for joining us yet again for another installment of the Youth Entrepreneurship Network. Our conversation, as Albert has already spoken to, is real estate finance and funding models. We have 3 panelists who are going to make some presentations and introductions. We will kick off then our discussion with a few questions, and then we will be inviting everybody on the chat to engage with our speakers. Please note, my speakers, that I will be giving you time to present. I will switch off my camera, and the minute you see me pop up, just know that you have about 1.5 minutes to conclude your presentation, just so we allow sufficient time for engagement with our attendees. So I won't interject until I'm pressed to do so. But please be considerate then of time because we only have 2 hours, and I imagine we all have a mouthful to say. Without wasting time, I will kick off our presentation with Bush, the new victor who had hair and doesn't have hair now today, to kick off our presentation this evening. And once he has done, I will invite Mr. Matonsela to do the same. And then last but not least, we will have Ukojo go ahead, and then we will kick off our roundtable discussion and invite then our attendees to connect and engage further. All right, Victor, the virtual stage is yours.
Okay, yeah, thank you very much, Zandile. Thank you very much, Albert, for setting up. And hello to other panelists. It's good to see you guys. It's good to be with you. It's good to network with you again. So I'm gonna start off by introducing myself. My name is Bush Victor Paradzai, and I'm a managing director and senior property valuer at Pyrite Paradise Real Estate in Botswana. And currently I'm over a decade of experience in this real estate industry. And I hold a BCom degree in real estate from Baisaro University. And also I have a certificate of plant and machinery and equipment from ECA, the Academy of Construction and Real Estate, and also a proud member of the RIAC, the Real Estate Advisory Council. As you can see, I've added a picture there. These guys are massive and they're doing their work. They've almost touched the whole country in terms of putting the rules and regulations so that we are all set, and also a proud member of the RIB, the Real Estate Institution of Botswana. And also, I'm an award winner 2025 as a rising star in property valuation. And also a big thanks to Eka and YEN for putting me through to youth entrepreneurship and networking. I'm seeing beautiful minds, knowledge all over the countries, everywhere, that are trying to come together and make a difference in this continent. And also, one of the important things I didn't want to miss in this presentation, I would like to a moment of silence for Mr. Benedict Koselentse, a RICS member, RIAG, and RIP, a guy who put me where I am here when I didn't have knowledge of property. So back to the topic. So real estate finance and funding models. So I'm gonna try and simplify this, because as we youth, we tend to see real estate finance as bold words that are scary to just digest. Some of the people, they just see them far away. They just see them far away and say, no, the topic belongs to the guys with monies, the guys with finances and stuff like that. But I just here to just simplify this thing so that all the guys that are coming up, so that they can see that these things actually, they are very, very, very easy to see and digest and break down into smaller pieces, and then you tell yourself that you can make it in difficult times and in time. So I'm going to start by real. So a real describes a physical, fixed and unmovable asset, specifically land and anything attached to it. As you can see, I've added a picture there. That's something real, that's land. And then on the other side, on your right, you can see there's a building structure that is attached to the land. So when we talk about real, we talk about things that are real, that are as for example, that I've said land. And then we jump to an estate. An estate is not a physical object. It's a legal interest or a relationship a person has with land. So it defines the nature and the degree and a duration of your ownership and the usage of right. As you can see there is a 99-year lease. And then on the right there on the picture, there are title deeds. So, and if you can know that you have a real estate, actually and then it has to be documented. You have to have like a duration of that document and the land of how are you holding it, for how long are you going to be holding it. Some of they differ in terms of some get the freehold, some get the state land, whereby at the end of the day you have to reverse that land to the government. So, and then we put the two together. So the two will then describe a physical, fixed and unmovable asset, specifically land and everything permanently attached to it. For example, if you have a 1,000 square meter house and then you build your double-story mansion, as you can see, I've put beautiful pictures, a double-story and multiple multi-res buildings, as you can see. So it explains that whatever you built on the land as long as you have a legal right to it, to ownership, it is yours. But you can't just come in and say you have, this is your land without any paper in it. And then we move to finance. Finance is a science, a study, and a system of how money, investment, and credit and banking are managed. It deals with how individuals, businesses, and governments allocate their resources over time and handle risk. The first picture there you see is like personal savings and personal funds. So it's the finance, it's about how you as a personal you manage those finances. And then the second picture you see it's a business trying to unlock the key to the capital, and then to a construction site. They are trying to get capital so that they can invest and build something like that. And then when it comes to the government, you all see all those things that are all the resources that the government manage to allocate that thing depending to the risk. And then the financing part. So that's the interesting part. So we are getting there. So it is a specific process and of acquiring capital money to fund a business or purchase a long-term project. It answers a practical question of where are we getting this cash from? You can see I've put it all the pictures together so that they can paint a beautiful picture out of it. There is a first picture of a real, which is land, of which the second picture on top, it says finance. How can I structure? It starts with the dream of developing projects, the plans and stuff like that. And then the second one, it will then say, where am I going to finance this dream into that land, right? And then I put in a tree with money there to kind of like put an understanding of when you pour water into the tree can grow very fast. So it's like saying if you can put money into your project, if there's funds into your project, it will then become the last picture that you are seeing in the picture there. It will then, when with land and you have proper funds, you tend to get the development of your liking. So funding models, these things are like building blocks of property projects. If you for example, if you get to the bank will give you the money from the foundation, the walls, the roofing, and the interior. So that's how I tried to make it simple so that you can understand where are these things related. And then we move to the real estate finance. So as you can see now, we have that picture. That picture, it's nice and it's amazing. It simple says, when you have a title deed and when you have the guy who finance you, and if you have the right people and the little funding that you have and the right information, you can actually come up with the real estate. So remember when I said real estate is like owning property with legal documents, not just saying you have a property, but not having proper documents of the property. So it's simply a branch of finance dedicated to the sourcing, structuring, pricing, and managing of capital used to acquire and develop or operate land and building. Yeah, and then we move on to the next one. So think of real estate finance as an overreaching strategy, rules, and mathematical formulas used to analyze a deal. Think of funding modules as a physical machinery or phases that deliver that capital step by step. It's like playing a gig. Financing is like playing a game where you can start unlocking the foundation. At first, you start unlocking the funds first, and then after unlocking the funds, those funds will come level by level until you finish your processes. So then I'll move on to the now that we have separated all the concepts, finance is a big picture strategy, and financing is an act of getting the cash. We can look at the actual type of funding and financing option available to businesses and individual and projects. So there are types of fundings and financing. So we start with depth. We all know that the simple way of financing nowadays, borrowing has became a more easy and famous one when it comes to getting a fund fast. A lot of people will then get a loan from the bank, get a mortgage, asset-based lending, lines of credit, depending on what are they bonding on. So all this debt financing, they will also come with advantages and disadvantages. Some, they give you 100% ownership if you didn't partner with anyone. And the disadvantages is that there are no loss control. So when we say there are no loss control, is that you know when you get a mortgage, you're gonna pay double or triple. That's something that you cannot hide and you cannot control. And also you know that every monthly it's an obligation that you have to pay the guys back. And also must be repaid with interest. We all know that if you borrow something, you have to bring it back with something on top, so that it becomes a fair deal for the guy who lended you money. And then the second funding, we have the equity financing. So this is whereby now the people who started borrowing, they are now starting understand of trying to break through of stopping borrowing, but using what they have, selling maybe a piece of land, the piece of ownership, so that they can fund the other half that is left on their piece. So this finance funding, there are few people who do that, but there are few people who do that, because you find out that there are a certain number, maybe 60% of the guys who own land in the country. So they're the only guys who can manage to do that. And they know that the advantage is that no repayment obligation. But what they do is that they know the disadvantage is that they can even come together as a group. For example, like angel investors, crowdfunding, and from stocks. These people is like they share profits together, and some people don't like sharing profits together. And also the decision-making power, you are not alone, but you always with your partner. When you try to move your what you got from the bank to the other bank, you have to consult your other partner. And lastly, we have the alternative hybrid models of funding. Those ones are from the government. We have a lot of advantages here in Botswana when it comes to this government financing modules. you'll find out that some of the fundings are free capital provided, and some of them you don't have to pay back them. Yeah, and but then the disadvantage is that it comes with a strict rule, and they control on how those funds are going to be used. For examples, we have like grants in the government, we have the NGOs, we have the youth development funds, we have a lot. So, and then I've just gave some few examples so that some of the attendees can relate on what I was talking about. When we come to debt finances examples in Botswana, we have like commercial banks and development loans. If a business wants to buy a commercial business or secure a mortgage to develop an office block, maybe for example in Gaborone, CBDs or showgrounds, they look at the commercial banks like FNB, Stanbic Bank, and BBS. The bank will provide the cash upfront based on the valuation reports. So that's when we come in as valuers. So we have to make sure that these valuation reports, they are up to standards. They demonstrate the true worth of the property, so that also the guys who are investing, they can have trust in us. And also the individual companies, they can then pay it back in interest as time goes on. And then we have like the equity financing examples. Some of them are examples in Botswana. We have like at an early stage startup in Botswana. Like pitching for a private investment from a high network individual interacts with network like the angel network in Botswana, like ANB, for instance. They previously stepped into the providing early equity funding and mentorship to the local startups like Vantage Properties in prop tech space. Yeah. So, and then also we have the venture capital and private equity. We have funds like the guys who like help youth in the Southern Development in the SADC region, and also the pension funds, the BPOPF, as local asset managers. So we have, there are many guys who like come together and try to help you with proper business ideas and stuff like that. And then on the government side, we have the youth and citizen empowerment funding. These guys, they are very strict. So your application can take like the whole year trying to figure out how can I get the business plan together, get the documentation, get the bill of quantities, get the valuation reports, and also so that they can, at the end of the day, they will end up giving you the funds. As long as you are a youth, and also they always empower the ladies. If you are a gent and a lady, they prioritize a lady first, and then the youth, and then the guys, older guys will then come last. So, and also we have the Botswana Innovation Hub, BIF, administrated by the Botswana Digital and Innovation Hub. These are primary example of the funds that are coming from the government side. Not forgetting those that are under the government, that they are government schemes like GENVAS. They give the government employee at a lower rate, and also schemes like SHA. These are self-housing agencies that are meant to help the guys who can't afford to build for themselves. They will then give you a loan of maybe 100,000 for you to start building your own 2.5 or a bachelor pad, and then you repay them as little as 300 every month until these are long-term leases until you finish. So there are limitations of all these things. Like I said, for you to be funded, you need to have all the requirements needed by the bank or the guy who's funding your project. You can't just come there and say you want to be funded. As you can see that picture that I've put it there, take away one thing, you will never be funded. There is a gentleman there, there's a title deed, there's a 10-year visa representing the passport or the ID, and there's a calculation there, there is money, and then there is a house. Take away the house, they will ask you where the money is going, what are you finding? If you can take away the person, who will make that? Or if you take away the lease, bank or any funding guys that don't give you money, especially when you don't have a document, they will never give you that. And also some of the banks, when you don't come with your down payment, they will always require you to always come with a down payment. Or maybe some of them, when you don't have, they will opt for giving, instead of giving 100% financing, they'll then give you like 70% or 80% of financing. And then we move on. Here I explained the limitations, and then why financing is structured properly. So there's things that make a lot of people fail in terms of when they get the funds from wherever they are getting. It's either an investor, it's either a bank or stuff like that. They would then want to manage that money themselves, but knowing that that money is a risk matching. A raw piece of land without planning, permissions has a higher risk profile than a full list office building. So, and also when you look at the capital efficiency, developers only draw down the specific modules or capital they need when they need it to avoid paying interest on millions of dollars while while it's sitting there idle. So what they do is that they are fund management companies. They gather the pools of monies from many investors and use them to purchase securities. These funds are managed by professional investors, managers, which may generate higher returns which then reduce the risk by assets diversification, something like that. And then lastly, the benefits of real estate funding activity. So as an individual, when you know that you have secured a fund, the benefit is that you achieve a personal home ownership as an individual. Also, you can build long-term generation wealth. And as property developers, they tend to benefit a lot. They optimize cash flow, ensuring projects do not stall due to upfront capital depletion. And also they mitigate the risk by utilizing structured step-by-step to funding modules. So there are those guys who will be then, getting the funds so that the ones that they have within the company can build the projects, and the one that they're getting can like pay the employee so that they can finish the project faster and start another one as that one is on the finishing stage. So that's what they do most, and that's what I see in Botswana, that when the project is halfway to be done, you will see those guys running to another land, starting the foundation and stuff like that. So I think that's all. Yeah, I think that's all. I think I see you popping up. That means the time is up. Thank you very much. I tried to rush it through. Thank you very much. Yeah.
Sure. Thank you so much, Mr. Paratzai. And I think we did an injustice of not allowing you to even introduce yourself and get right into your presentation. But for the comfort of those on the chat, I do see a question on, or rather a request that the slides were not as clear. So we will be sharing that. I do see a response by the ACRE team, but I want to give comfort to everyone on the chat that everyone who is online right now will receive these slides post the webinar. So we will further engage. Now, the beauty of being the moderator means I get to decide how we are steering the ship. And I know I had initially said we would allow all the speakers to do a presentation and then come back for questions, but I'm also cognizant that there may be an opportunity where we lose questions and also just allowing then some of the attendees on the chat to think about what it is they would like to engage once we open up the floor for official Q&A. So I think let's tackle your questions, Mr. Victor, as you've already presented, so that we kind of warm everybody up to the bigger discussion. So you spoke about a lot of things, and I appreciate truly how you've laid the foundation for everyone's understanding on what real estate is, and then bringing in the component of financing so we understand just the building blocks around real estate finance, and then speaking to funding models. I think it becomes really imperative in line with the theme of these webinars, which is to navigate the terrain and also empower then the next generation of property entrepreneurs. And thank you so much for the foundation that you've laid. So you are the managing director of Pyrite Paradise Real Estate. And I'd really like for you to probably talk us through what your finding challenges may have been when you started off building your firm. And I think the prerequisite of the session is that those property entrepreneurs, the potential ones and the ones that have already established their companies, are cognizant of some of the challenges that they could face on their journey. So maybe if you can tell us what are some of those challenges that you faced when you started off your firm, and even give us some advice on what the next generation can do to navigate the Botswana property market for those who are interested to cross borders.
Thank you very much, Zandile. Yeah, I don't know. Okay. Okay. So, starting with to overcome this industry, it's difficult because I entered the industry with on those days in COVID. So it was difficult because some of us were already just signed it, that it's in, lose it, it's either you are in or you are out. Because I started this real estate journey by building the different companies. That's what I can say, so that I can have proper cash flow. I had a company for the cabs, and also I had a small company for photography. So all this were my gateway to come here, my shortcut. So when COVID hit, those things decided, they decided to vanish. And then during the COVID, I was like, you know what? It's whether I'm in it or what. Let me just go all in. So it was very rough. But what I did, and then I said, to overcome these challenges, I should start by knowledge first to gain wisdom. I have people who fitted my mental state into proper condition. You would rather have your mentor. It's either I had a mentor at church by E.H. Maulana. I would just go there to listen at the guy, and the guy was even now. I would like listen to the to my father, and also I gained more insights and more strategies during networks conferences. I've never missed the property valuation conference. I will always make sure I go there because it gave me a small spirit for me to always wanna be doing better. So, and also technology, nowadays things are moving fast. For you to be quick at learning, you have to find an app that can boost you to be where you want to. If it means you are typing slow, if it means you need to take minutes, you need to have something. You can't be listening at the same time taking notes. You have to have something that's taking notes for you, and you'll be understanding and try to those things. So I utilize everything. I utilize, and also being patient. I've always been being patient with myself. I've never rushed anything. Even if someone have to say, please, I'll pay you this much, increase the valuation report, I make sure that I become patient. I'll be like, no, say maybe next time. Even if it means I don't have to get paid, but I'll make sure that I do the valuation report and the guy submitted the bank. And then after he gets the funds, you then come back to me and say, I managed to get the funds. Get your pays here. So that's how I managed to be where I am. So if currently, I always fight with the account guy, say, why is the money you have not on you, but it's on people? I was like, no, don't worry. After we sell, we'll get our cut. That's how I've managed to become patient with everyone. And the next one, can you repeat it again?
So what is the advice that you can give to the next generation of property entrepreneurs on navigating the Botswana property market for those who wish to go beyond the border?
Okay. So for the guys who want to make it, so that they can be where they want, it's like I can just go back to the example of financing. It's like when finance, it's not like the project done, but it's like a dream whereby the architect, the valuers, they should project the future of how much can they get from the bank. And then they come together and get the quotations from different places, and then they challenge the bankers. Because I can give this example of saying there are young guys in Botswana who are fleeing to the UKs and stuff like that, right? You get it right. And then you figure out how did that guy connected the dots. It came with a dream, and then the guy connected of how am I getting the visa? How am I getting the 200K inside my account? That 200K is like a fund. You get, and before you are in the UK, you formulate a plan until you make that plan happen. But I can say to the guys who are going there, please guys, come back and do that same thing into funding real estate. With that 200K into your account, you can come to me and buy the land for like 30K and build it for like 100K. And then boom, every month you are getting your monthly rental. You get, instead of going there, some of them are coming back without anything, you see. So that's what I can say. Do it here, because if you don't do it here, the banks need us so that they can operate. Without us, the banks will never operate, and they will go back to their home countries. So they need us as youth so that we can use them. And if we use these banks, they will always provide us with more. And the more we are, the more the rates of the banks will become lower. But the fewer we get, the rates will then become more. So that's what I can say to our youth in Botswana. Let's stand together and get funds and then build. You see how Dubai are doing. Yeah, they're getting funds and building has. It's not like they're getting from their own pockets.
Sure.
Yeah.
No, thank
So,
you. Thank you so much, Victor. And I love how you touch on just the importance of ourselves to the banking system, right? Now, I want us to touch maybe on how young entrepreneurs could leverage specialized assets. So we know that as property entrepreneurs, you'll most likely have plant machinery and equipment assets. How can entrepreneurs, particularly in this space, who have these assets available, use these non-traditional assets as collateral or value add components in an effort to finance their real estate endeavors?
yeah, that's a tough one. But let
Give it
me
a
just
shot.
yeah, because I've valued farms many times. There is a way how a person who didn't do plant and machinery will value it. You like value the land and the fencing around it, right? And then some of the things like the equipment generators, solar panels, like the reservoir and all those things, he will not have the idea of coming up with the valuation of all the assets. So you will find out that they are giving a disadvantage for the owner who wants to buy something important to the farm again. Maybe he wants to get more money. But then the land, you find out that farmland is not is worth that much. But farmland together with the boreholes, with the equipments, with the irrigation systems, with everything, can give enough money, can give enough leverage for that guy to get money from the bank. So that's what I can say. For me, doing plant and machinery in Eka, it's a very brilliant move. I would suggest all these people to do it, young ones, so that young valuers, so that when you value a yard, for example, the mine with equipment, you know what's this and what am I touching, what am I not touching? Because some of the people will miss a structure just because they're thinking it's a plant and machinery. But while it's a structure that is permanently attached to the ground. I don't know if you get that.
Sure. Yes, I
Yeah.
think on a high level, we are with you,
Yes,
Victor.
yes,
But if
yes.
you can
So
break it down a little further, it would be appreciated for some of the people on the chat and myself, in fact.
yes, so this is okay. This is the thing, right? If you have one borehole,
Mhm.
let's say your land is worth 500,000 with the borehole, and then picture it when you have two more boreholes.
Mhm.
The other one is not working. The other one, the two more, right? The other one is it's working, right? So when you don't know a little bit of education on planton and machinery, what will happen is that it's either you will include all of them, right? And not knowing that the other one does not even add value to the property.
Oh,
You get what I'm trying to say? But if you have that knowledge of knowing what this borehole also has a certificate or doesn't have a certificate, you get, or is this plant for, what do you call it, for the solar system? Does it have papers? When I say papers, remember when we on the notes when we said, and in property, anything that has a paper like certified should be included. Some of the people include things that are legally included in the farms. So that means some of the things by law, they are not supposed to be included in the valuations because they are not properly, you can't just come and dig your own borehole, you get, and say we should include it into the valuation. It should have a proper certificate. So learning plant and machinery, guys, is very important because you tend to add more value to the client. Where he thought he would give up, you will say, let me just go look at that. Maybe there are some of the equipments you can add on, and then you can then leverage your strength in financials. And then also it can also add a little bit more on collateral. You get collateral is like when you buy a big plant, let's say a big generator that when the lights go out, it starts generating, right? So when you have that within your property, some of the valuers who don't appreciate, who don't have a little bit skills of plant and machinery can miss that and say, this is not part of the house. You get. So, and then they would then value that house as a million. And then instead of putting that within the valuation and stating your notes that you have added this and this, that money could actually be useful to the owner so that he can get more from the bank. Yes. So I think some of the things, yeah, I will hear them from my elders here.
Yeah.
They are there and they are listening. Oh, this guy, you will give him a little bit more taste on everything.
Thank you so much, Victor, for really laying the foundation for us. And I think if ACA at any point has an opportunity to have a masterclass on the precision of property valuation and just an opportunity for you to speak to then how valuation for plant machinery and equipment, I think it's a whole other lesson on its own. And thank you so much, Victor, for sharing.
Yes.
I would like to, at this
Thank you.
moment, invite, you're welcome, Mr. Madonsela from South Africa to talk us through his presentation. Mr. Madonsela, the virtual floor is yours.
Thank you, Zandile. Am I audible?
Yes, you are audible and you are seen.
Oh, that's okay. Now, let me quickly share my presentation. Okay. All right. I hope you can see the presentation on your side.
We can see it, Tsietsi.
Thank you. Good evening, everyone. My name is Tsietsi Madonsela, a professional valuer, a founding member and a managing director of Lutendo Group, a valuation firm based in South Africa. We do property valuations in South Africa for a number of institutions, including banks, government institutions, and some listed entities. Today's presentation, it's about real estate finance and funding models. I'm glad Victor actually went into length and actually took us into the fundamentals of real estate. And I don't have to go through that. Thank you, Victor, for that. Mine is to really touch on the role of a valuer in this whole process of funding in the real estate space. And one of the core questions that the valuer should really ask is, can the property support the debt, the equity return, and the exit value? Which is mostly what the financial institutions are looking for prior to actually lending on a real estate asset. Let me, I think on my side here, the slides are, I just want to remove this down here. Thank you. So, like I said, mine is to touch on the valuation of these assets, or where a valuer comes in or and plays a role in the whole process of asset finance. And I'll touch on the process from end to end, from when the investors approaches the financiers to when they exit on that asset. I've got three principles here. One, valuation determines how much a property can carry. Two is that the different funding models carry different risks profiles, matching the model to the asset is the valuer's core skill. So basically what I'm trying to say here is that every asset it's got its different, in the valuation space, there's a different approach to that asset depending on what the investor wants. In some instances, you find that the investors, they just want a certain percentage from the bank to be funded, and the certain percentages will then approach your mezzanine financiers and so forth. But I'll touch on those processes as we go ahead in the presentation. Three is that the income quality or exit value and the debt serviceability are the three pillars even every financier tests before committing to capital. To the next slide. Sorry. There. The funding core of funding models. Model A, it's a senior debt. I think didn't I? I think I've skipped a slide. Sorry. Oh, no. There. The first model it's a senior debt. This is what I was talking about. So when a funder approaches a bank and they want, let's say for argument's sake, 100 million, the bank will then say, or the financier will then say that we'll give you 70% loan to value. This is on interest only or amortizing. This is now when they try to see that will this asset be able to pay us back? Is this asset bankable? Are you able to get rent into perpetuity? Model B is the development finance. So the development finance speaks to when the development starts from scratch and the financier comes in and say that we'll give you 60 to 70% of the cost. And what they do also is that it's a draw process. They don't give you the entire money. The money gets paid in percentages from the beginning until the construction is completed. The equity JV, basically, this refers to some of the big projects where perhaps you are a first timer into that. Perhaps you approach a bank and you want to build a shopping center, and the bank says to you, hold on, Mr. Madonsela, we have somebody who's been in this space for a long time, would want to first JV with this person so that we are comfortable that you are able to can run this type of project and be able to obviously pay your debt or be bankable as well. And the last model is basically a blended finance a model where I say that the senior refers to the principal debt. The mezzanine would then come in and say, okay, the bank has given you 70%, we'll come in at 20%, and you must then bring the 10%, which is a sweat equity, which most financiers will then say that, but what are you bringing into the space? We can't just give you money and you're not bringing anything. So they always want you to show some sweat equity there. So funding fit for asset classes. So what I'm trying to show here is to show different asset classes where most investors would then approach the financiers. You've got your residential. This, I think, majority of our property investors are familiar with, and most of them actually start with a residential property. It could be your own a home or you buying a second a home. So this is what we're referring to. This is mostly the mortgage bonds. I mean, those that have been involved in a process of applying for finance, they'll understand the process that this takes. And in some of this as well is that the banks, in some cases, they don't give you 100% loan. In some cases, where some are first-time homeowners, or when perhaps the bank is not really satisfied with your income that you're able to then repay back, you find that they go in as a certain percentage, either 80 or in most cases it's 90%, and you then have to then bring your sweat equity there in a form of a 10%. But while I'm still on this one, before moving to an industrial, is that even for mostly when you're buying like your second home, which is in this case would be an investment home, is that the bank also looks at a lease as a form of an additional income that you can then use to be able to afford whatever loan that you're requiring from the bank. In the industrial properties, we say that these are like senior debts, work well with location, access, power, and lease quality are strong. So basically what's happening here as well is that either you're buying it as a complete structure, or you are an investor who wants to then develop that industrial property. The first thing that comes into into the mind of a financier is that, are you going to occupy the property? No, and if no, they would want to know if there are any leases and if those leases are quality leases. I mean, we often hear of triple net leases where some of these leases are like more than 10 years, and if it's more than 10 years, it has to be registered. And those type of leases are the leases where the banks are comfortable in lending you money, because then they know that, I mean, if you have a lease that is 10 years and your loan is 10 years, you are able to then repay repay the debt. Retail also, these are like shopping centers. In this type of finance, the banks would also want to know who are the anchor tenants. These are like your, without really naming them, but we all know this big food stores, Pick and Pays and them. Those are like your anchor tenants, and the banks would want to know who are your anchor tenants in your retail development. And those type of tenants, the banks or financiers know that they tend to sign long-term leases, and before they even jump in, they would have made their own feasibility study to see if wherever that location of the shopping center is feasible, and they'll be able to then make money. So the financiers will be able to jump in there. Offices is the same thing as industrial. Also, I mean, you need to look at where the development is. Are they high vacancies in that area? If you're buying an existing office block, also they want to see if is there any capex risk in that. Whereby you buy an office and you find that there's a whole lot of things that still needs to be done in that. And if the bank gives you a certain amount of money and 2 years down the line, the offices are not occupied because you're saying you're still busy with renovations, and so there's risk in that as well. So when you're doing valuations as a valuer, you need to look at such things because the financiers are mostly looking at risk. Will A be able to pay us back? If not, they're not jumping in. The land, this is one of the critical type of properties where most financiers, they know that buying a land has its own risks. Banks don't go in on 100%. We know this ones, and also it depends on the types of development that you go in. So also what the valuers need to do here is to really look at the zonings. What is the permissible type of structures that are required there, what are the coverages and so forth. The banks need to know that before they can jump in. Hotels, which we normally say in our space that these are like specialized types of properties simply because of the occupancy, the location. I mean, Victor spoke about COVID there. We know during that period of COVID what was really happening to the hotel industry. So when you're doing evaluation in this space, you also need to be very careful in terms of really identifying the occupancy levels, and also just to really look at if it's a group, or is it a new hotel, or somebody investing as an individual into a hotel space. So such risks needs to be looked at because financiers are really scrutinizing a lot in such spaces prior to funding. So what I've done here is tried to show the difference between the equity funding and the debt funding. This is the core of our presentation. If you look at our topic, really speaks to this part here. So what's happening here is we know equity funding, it's you coming in with your money or bringing an investor to come invest in whatever development or property asset that you're buying. And also that investor would also come in to then say that they, want to own a certain share, or they might be owning 100% of it until you repay up to a certain level. And so here you need to really look at the internal rate of return. There's a higher risk in this one because you basically using your own money. The only good thing about it is that there's no repayments, but you would have upfront put in a chunk of it. I mean, you'd imagine if a property is worth 100 million and the investment in that type of portfolio is an equity funding. So what it means is that you would really have to really come in high there. Hence, the risk it's very high. And I mean, what I've tried to show also, it's depending on the type of property, if it's land, you know, you would obviously, and it's a development, do your residual or what we call a development method in our space in valuation. The debt funding, this is where you approach a financier. And like I said in the previous slides, that what happens here is that there'll always be, depending on the type of property, but with the huge portfolios that we've seen, that we've been involved in, is that there's never 100% loan in this type of developments. The banks will always ask you to bring your sweat equity. Even with your sweat equity, you won't get 100%. So in most cases here, you see that's why we play around the 70, 65, 70%. That's what is happening in the industry. The bank will give you a 70%. You'd go and approach your mezzanine financiers. They come in and say, okay, we see you already at least secured a senior debt there in the form of 70%. We'll come in at 20, and you have to then bring in your sweat equity. I mean, the mezzanines are somewhat expensive because what they do is, you know, they almost come in as a helping hand in there to get you to what you want. And they, in most cases, it's easy for them to jump in once the senior fund has already jumped in, because they know that, I mean, all the due diligence processes have already been done and completed. And what they do is just to look at what is it that is required, and then jump in there for a certain percentage, and you still have to bring your sweat equity. So basically, you can see that you know, it's not easy. This industry of developers, there's a whole lot of money that is required for one to jump into that space. Here I'm trying to explain, you know, the mezzanine or project finance. So what I've done, if you look at the slide, is that I've tried to explain it in a simpler way. To say that, you know, your senior debt will be anywhere between 60 and 70. That's loan to value. Mezzanine will come in, you know, at 70, 85. That's basically adding on to what you already have on the loan to value. Preferred equity, it's basically what I was referring to as your sweat equity there. So I've also explained there what the mezzanine finance is. I'm trying to look at time. I see we already 10 minutes into the hour, 6 o'clock. So and Zandile will jump in as well just now. So let me move in quickly. So I've also done a process where a valuer is involved in this whole process. If you look at it, is that pre-deal, it's the feasibility study period. This is before the developer or an investor really brings their idea into paper. That's when you come in and bring that idea here. Mr. Mpatlela approaches you and say that I want to build a shopping center on this land. This is what I'm thinking. That's where you come in a feasibility study and say, is this possible? Is this feasible? This can be doable or not. Then the funding stage, the valuer comes in again, where a financier involves the valuer to say, hey, we have a developer here who wants to build this. This is how much they're looking for. Please look at this and do evaluation for us. In the build stage, this is where the progress draws are done. Like I said in the previous slides, that the bank doesn't give you all 100 million, it will give you based on progress. The valuer will always come to site, comes and said 20% progress, the bank will give you 20% of the amount, 40 and so forth. Lease up, this is now when it's done and Mr. Mpatlela is doing his leases. The valuer comes in and look at if the leases are like market related, is Pick and Pay, and Mr. Madonsela paying me what is supposed to be paid. Annual portfolios, this is when now the investor says, can you please relook at my asset? I want to see how much is it worth. My accountants wants to put them on my financials and so forth, exit, and when they exit and eventually sell that asset after a certain number of years, then that's where also a valuer comes in and does the valuation. So the three core valuation methods I've touched on, it's the income capitalization method. This is best for income producing properties, your retail, your office, hotels, and so forth. You've got your residual, which is for development. That's how I said, like a residual approach, which we call it a development method. Comparable sales is a direct comparable sale method where we say rate per square meter is this much. Similar types of properties are getting this much. This is a direct comparable method. I'm not rushing. You'll excuse me, people. So I've also given a sort of examples of some calculations where I show now loan to value, what it means, which is your market value, which is the value of what you want to buy, which is 12 million. The bank comes in at 70%. It means that they're going to give you 8.4. I've made some comments. I'm going to share this presentation with you so that it can be shared with the entire participants. Debt service over ratio. This is basically your net operating income divided by your annual debt services. This is what the banks do if they want to see that really will you be able to, is this a bankable project? So this is what they actually do at the banks. Cap rate income valuation, most investors will always say, hey, what's my net operating income? What is the cap rate? Let me see what the value of the asset is. So this is basically what happens. This is high level, what I've done here. Residential valuation, this is, like I said, the residual. It's when you then want to know if I build this number of units on this land and you're trying to find the value of the land in terms of the development. This is when you already have rights to develop and so forth. So basically you start, excuse me, at the top where you assume your total project's value, then you start deducting all those deductibles that are normally there in a construction project. Then to get to your residual land value, you see that what I've done here, it's high level basically in giving it percentages and what's deductible. Funding stack, who takes first loss? That's, I think I've explained this thing. It's basically your senior debt and your mezzanine. I've just given a calculation here for easy reference. This is, our due diligence, what we then look at when we approach these types of funding investments. So these are some of the things that I've just summarized so that valuers need to really take into consideration some of these factors before they conclude on their valuations and be sent to the bank, because there's a whole lot of risk that is involved in there. And the only thing that the banks wants to know is that risk. Can we jump in? Do we not? I mean, Victor touched on something like, even if somebody comes and says that, can you please give me value? I'll give you this. We get a whole lot of those things because we are basically the key to that finance. If I say to the bank, no, Mr. Mphahlele, what he wants to do here is not going to work, he's not going to get money. But if I say, yes, he can jump in, or you can jump in at 30%, they'll do that. So they basically depend on me in terms of the value of these projects that developers jump into. 2 more slides and I'm done, Zandi. I've shown some key risks here. What a valuer must then identify: the market risk, liquidity risk, construction risk, regulatory risk, valuation risk, and the SA micro risk. Here are some key takeaways. I think this, I don't need to be taking anyone through this. It's basically what I've touched on throughout the slides. And like I said, this will be shared with everyone who's attending this. A good funding starts with an honest valuation. If the value is overstated, the funding model is already weak. Like I said, it's dependent on us as valuers to be able to guide financiers and funders out there in terms of the risks of some of these projects that they jump into. Thank you, Zandi.
Sure. Thank you so much, Tsietsi, for that comprehensive presentation. And like Victor, I have the sentiment that you should be running a masterclass on really how we can get value out of institutional funding. I think it's really important. And I also appreciate that you'll be sharing this presentation with us so that we can really align. I love that you spoke to then valuation precision. And I want us to maybe look into valuation as a potential funding tool. And maybe we could encourage some people on the chat who may not be property valuers by profession. And how do we then, as young entrepreneurs in the property sector, use property valuation and the correct or precise property valuation to build trust with our lenders and secure competitive financing?
Look, you see, I always tell most of the investors that we work on mandates like any other professional or consultant. I mean, you would imagine if you're going to a lawyer and you want them to represent you, but you're not giving full details, they'll misrepresent you. It's similar to valuation. So if you want me to then represent you in a form of providing a valuation report for a certain investment that you want to jump into, you'd have to give me a proper mandate. You have to give me a full scope as to what is it that is required so that the end result can speak to what you want. So that when the valuation goes to the bank, it can be easily interpreted by the bank or whoever it sits on the other side of the bank before they can then jump in. Because if it's not representing what you're looking for, we're going to have back and forth. But also the back and forth is that you run a risk as well as a funder or an investor to lose on that finance. Because once the bank starts seeing that figures are going back, are changing, financial statements are being changed, so the first thing they're thinking is this guy is trying to cook the book so that they can get favorable value on the property.
Sure. No, thanks for that, Mr. Madonsela. You've spoken through your presentation around critical components for investor readiness. And now your latter response touches then on governance and a strong need to ensure quality assurance. Can you maybe talk us through how critical these frameworks are for an entrepreneur who is seeking to attract private equity or institutional investors?
Look, governance and quality assurance are critical because investors do not only invest in the project, right? They also invest in the people, they invest in the systems, and those are like good investors, right? They invest in the controls behind the project. So governance and quality assurance is very important. I mean, private equity and institutional investors want confidence that the business is well managed. So if I just come as this Mr. Madonsela that is claiming to then give quality work and I get exposed once it's presented to the third party, you don't want that, you know. So it is important to have that governance and quality assurance.
Sure. No, thanks so much, Mr. Madonsela. I don't want to run the risk of monopolizing this conversation. So at this very moment, I would like to invite Mr. Kojo Asare to take us through his presentation and sentiments. And then hopefully we'll wrap up in just enough time to allow our attendees to engage with all of our speakers. Apologies, Mr. Kojo, we have not left you behind. Mr. Hasare, you can come through if you're ready with your presentation. There we go. I see your camera is trying to go on.
Yes.
There we go.
Hello.
We can hear you, Mr. Hasare. We just can't see you.
Okay. So my presentation will be actually on like from the national government perspective because of my background and then the position I occupy. So it'll be from looking at the funding models from the national government perspective. So as my earlier seniors mentioned, we have the bank debt or the mortgage financing models, which it works in a way that the bank lends a percentage of what you need to invest the property to you, and then you have to find a way to add up. And then at the end of the day, there are monthly repayments, which may not necessarily be from the income the property is generating, but from maybe your own sources of income that you have to be making monthly repayments. And from this bank or mortgage finances, mostly that's what a lot of government workers use to put up their kind of residential facilities they live in. So, and then mostly the repayment is from their salaries. So sometimes they can spread the repayment, and that's principal and interest, which we all know of, over 5 to 25 years of their working career. So, a retirement age is 60. So they kind of structure the finance to which you can repay from 5 years up to 25 years to kind of finance the home you live in instead of be renting. And then the interest rates also kind of vary from country to country. For Ghana, the interest rate ranges between 15 and 23% because we have the GRR, that's the Ghana reference rate, and then a risk premium is added to it. And then for Nigeria, it's between 22-28% of lending rates. And then for Kenya, between 14 to 18%. And then for South Africa, I don't know whether it's right, it's between 11 to 12%. And that's quite lower and very encouraging for people to borrow and then finance such their residential real estate. Then we have the equity investment in which mostly investors bring the cash and then set up a special purpose vehicle company. And then at the end of the day, you as the developer, you develop the property, mostly commercial properties. And then at the end of the day, the income that property is generating, you use it to service the loan the investor gave you. So with this, no repayment pressures. The lender won't take the property if the market dips. So when the market dips, the lender will rather help you to maybe strategize, maybe put in some marketing strategy to bring the upskill the property so that the income that is generating, it can pay him and then you make some profit out of it. And then we have the joint venture. This is where a lot of those from the national government use a lot. So national government mostly owns vast lands, and some of them very prime in prime areas. Most of all those lands are controlled by national government. So what we do is that we do a valuation of the land using the method my earlier seniors mentioned, either the comparative method, the residual, method or the income capitalization method to kind of value whatever you have, value the land, and then with that, the developer will also bring in some capitals, and then at the end of the day, you should be able to know the profit sharing with the land value, and then what the amount the developer brings. You should be able to know what the profit sharing ratio will be, whether 40-60 or 50-50. The evaluation will be able to determine that. So this one relevant area of our work as valuers. Most of the hot markets that go into this finance structure is Accra. So most of the big structures you see in the center of Accra, most of them are luxurious apartments, are joint ventures where the people and or central government has brought land, and then the developer has brought capital to put it up. Lagos, Nairobi, Kenya, Kigali, and mostly we have these diasporas who also want to use their family income to invest in properties in Accra and the rest. So mostly when we have them coming, they fall on national government because we, for due diligence purposes, they fall on national government for the searches and to verify the root of title and the rest before they are able to go into such arrangement. Then we have the real estate investment trust, a kind of finance structure that has developed very well in South Africa. It's now developing in Ghana, and for Ghana we have the home finance rate, and then the UPDC rate, and the minimum actually is the capital or the liquidity is not that much, around 100 to 1 million K, 1 million. So with this, diversify with small money. So this one, everyone can come and buy share in that real estate company, and then those capital is used to kind of put up an investment property. When we talk about investment property, we are talking about maybe shops, offices, hotel buildings, and the rest. And at the end of the day, whatever profits that comes out from the running of the place is shared by virtue of how much shares you bought or how much rate investment you have done. And then the bigger one now as national government is the development finance institutions debt. So what the development finance institutions, that's the FIFCs, that International Finance Company, AFDB, and the rest, what they bring on board. These are long-term loans at lower rates. Sometimes, though the interest rates are around 15 to 22%, these development finance institutions bring as debts as low as 6 to 10% for investment into mostly affordable housing, and this is where impact investment actually takes place. This is where sustainable and responsible investment actually takes place with national government. So affordable housing in Ghana, we have one that was this development finance institution in Switzerland provided for the development of the Sagleme affordable housing. It was supposed to be over 5,000 housing units. It is there, but there has been some project hitches because of some ESG compliance issues and then audited accounts, which these development finance companies are very critical of. So there has been some hitches. Else that project, about 5,000 houses, could have reduced the housing deficit of the country from 1.7 million deficit. So there's a lot of advantages here. The interest rate is cheaper, the money is long term, and then there's always a lot of technical support to national government. Then we have the bridge and then the blended finance model, where the bank gives kind of a loan to national government to add up to from whichever fund they are looking at. So for Ghana, again, we have the National Home Ownership Fund, where the government will give a percentage of loan to a government worker, and then the bank can also add to it, this to kind of reduce the risk on both the government and then the bank or the bank in issuing out loans to government workers. Yes. So, and then the final one, we have the owner financing. That's the owner financing. Maybe the owner has land, and then he uses the land as equity. He approaches the bank that he uses the land as equity. So we as the valuer gives the owner the valuation report to take the land, and based on that, the bank gives him a particular certain amount of money to be able to develop his residential property. So this also one finance structure that the owner himself, as a government worker, using your pay slip and then the equity you have in a land you have purchased or a land a family has given you, you register it very well through the land title system, and then you go and then you approach the bank for them to give you some kind of facility to put it up. So this is the practicality of finance structures from the viewpoint of national government.
Sure. Thank you so much, Mr. Asare. And I love how you've painted then the picture of development finance and giving us a public sector perspective on some of the opportunities that young entrepreneurs, particularly in the property industry, can tap into. But I want to talk about the synergies around public and private partnerships. And given your role in a public entity, what other innovative funding models do you see emerging that will allow young property entrepreneurs to partner effectively with state entities?
Yes, so we have a lot of funding models that an entrepreneur can partner with these development finance entities to be able to kind of bring up real estate. Yeah, so actually we have the SPV structure. So an entrepreneur, right? The most critical issue for an entrepreneur is, are you bankable? You have to be bankable. Yeah, so and what we are looking at when we are talking about the bankability checklist is the SPV structure. Hold each project in separate company. So as an entrepreneur, it means you have a company which the development finance institution can use as a special purpose vehicle. So you will be the developer, and then at the end you can kind of approach national government that, oh, I'm the developer. I have some financiers who is a development finance company who want to invest in maybe 5,000 affordable housing units, right? So you as national government sign up an MOU with I as the special purpose vehicle so that I can be able to pull in the financiers, because I will be doing all the legwork. When we talk about legwork, all the paperwork as due diligence, like making sure the land is titled and everything, making sure ESG, like whatever investment that the financiers are putting their money through will at the end of the day give a benefit to the country as a whole. So the ESG consideration is very high. And then we have the clean titles. After I've spoken about, you, the developer, the special purpose vehicle must make sure that you are going with clean title. You are going with an audited financials. That's your balance sheet should be something that looks credible to the development finance institution. And then above all insurance, because at the end of the day, when the development finance institution is giving you the loan or the credit as a developer, they are also going to look at their risk premium. So your insurance will kind of help reduce the risk premium they will add to the interest rates that will be given to you. Yeah, so basically, that's the strategy the banks stabilized assets. So at the end of the day, you get like a stabilized income to be able to put into the project, and then have a wonderful or a successful project to be able to serve the purpose of the nation. That's from my point of view, to be able to reduce the housing deficit, which in Ghana is about 1.7 million. My length in Nigeria is about 22 million housing deficit. Yeah, and this is a headache, it's a burden on national government, and we need such finance structures to be able to overcome as Africans as well.
Yeah,
Thank
no.
you.
Thank you so much, Kojo. We are in a housing crisis as the African continent, and I think conversations like this then become extremely important because we are building synergies and potential networks to attempt to resolve our infrastructure issues. You spoke to bankability in part of your response, and a component of that then touched on asset management and how we could use that to potentially grow. How can the next generation of entrepreneurs use strategic real estate asset management to improve their bankability or the bankability of their property portfolios?
Yes. So the first point here is they have to, as much as possible, turn properties into data-driven assets. And thank God, our background as valuers, as estates and managers, we are capable of turning the properties. So you shouldn't only concentrate on the brick and mortar, but what is the returns on investment that the bank is when you represent to the bank, they are looking at. So talking about affordable housing, 1.7 million deficit, it means even 5,000 housing units will not be enough. So it's all about demand and supply. So that demand and supply will come, you can make a good data sense out of it to be able to present to the bank. And then at the end of the day, also we have to employ technology. Technology is very important in strategic estate management. So technology will help mark the KPIs, your KPIs for the for the investment you are doing. The occupancy ratio, 5,000 housing units, you guess the occupancy ratio will be very high. Your rent collection will be very high because housing is a need. It's a basic need. So everyone will want to put some amount of their spendable income to solve that. Your net operating income, what are you looking at as your net operating income? The maintenance cost per meter square, the tenant retention. This is what the banks ask for. That's when you are turning your property into a data-driven asset. And then also your digital rent collection. So now my office now, we are looking at how to collect ground rents. So those that we gave land we gave lands to develop, to use bank loans, to use the land as equity to develop their properties through bank loan per the financing structure I presented earlier, right? So at the end of the day, throughout the lease term, we give you about between 60 to 99 years. So throughout the lease term, you are supposed to be paying ground rent to national government. So we are looking and we are digitizing the rent collection point. That once we send you the message, we send you a link, and then you'll be able to use the link to pay digitally. So that's one way we are kind of strategically managing national government assets to actually meet the demands of the population. And then an asset register. So this one, we are using a technology called the Geographic Information System to be able to come out with an asset register where the document age, the lease expiry, the title status, and can also be guaranteed. So this one, we call it the portfolio granularity. So the geographic information system will be able to help us set up the portfolio granularity, where you can get, so just at a click of a button, you should be able to get every information on every parcel of land, which development finance institutions or the banks are very interested in, because without good title, you cannot be bankable, as we said. So our entrepreneurs should be very mindful of that. And the lenders can, your lease structure, you should have a very good lease structure. That's what national government will help you with 60 to 99 years. So you can decide that looking at your the time of payment, that's your repayment periods. Maybe you want to sign an agreement between 5 years to 25 years with the development finance institution or the bank. So basically, these are the steps we are taking as national government to be able to kind of strategically manage property for the benefit of all, irrespective of your creed, both the middle income, the high income, and the low income. So when we talk about affordable housing, we know that 30% of your income should be accorded for that. So the income bracket you are in, we are able to match that and then look at the risks you face involved, and then we'll structure the finance model for you. Thank you very much.
Sure. Thank you. Thank you so much, Mr. Asare. I do believe that you've covered most of my questions. I do have a question for the entire panel, but I'd like to invite, I see a hand from our panelists. It's an attendee. So I think this is the moment. I would like to invite our attendees on the chat to ask a question and engage our panel. And then we will wrap it up. Thank you so much to all our speakers for your wonderful presentations and your insight that you've shared this evening. Gashirai Emmanuel, please come through. I see your hand was up.
Hi, Zandile. Thank you so much for this platform, and thank you so much to the presenters. My question is going to be open-ended. I don't know who's going to assist us. So my question is, I could see that most of the presentations that came are for traditional methods of finance, and they usually work in stable economic environments. And my question is I come from Zimbabwe. I operate in the Zimbabwean economy. And to be honest, for a young entrepreneur, the issue of being bankable, it's very, very much difficult. So are there other alternative methods or advice that we could get in terms of getting finance to start up as an entrepreneur in real estate, besides the traditional modes that we have or that we presented? Because when we look at our economy, especially in Zimbabwe, I think mortgages are just like 2% of the market. So most of what's being operational, it's a cash-based economy. So that's where I don't know if there are any other modes as well or any other economies that are experiencing what we're experiencing in our market. Thank you.
Sure. And I know Emmanuel didn't direct this question to anyone in particular, but because we are from different countries on this panel, I would love to get a perspective from each one of you. And maybe to start at the tail end, Kojo, maybe you can kick us off in responding to this question.
Yeah, so when we talk about as a young entrepreneur being bankable, as we stated, to be able to access finance into real estate, and then depending on how the economy is, then maybe at the end of the day, that's what we're saying, that you turn the properties into a data-driven asset. So maybe you are a property, you start from a property management point of view. Maybe you have been given a property to manage as a young entrepreneur. You can leverage on that property you are managing through the data you acquire and then at the end of the day, present it to the financial institutions, because at the end of the day, they are looking at how you are doing well in your management skills, how you are doing well in managing the risk, how you are doing well in managing the maintenance cost and the rest. So if at the end you are able to provide that data to the bank, I think you should be able to leverage on it, and then you could get some sort of finance to be able to start another project. So at the end, so it's not about the how many properties you are able you have, like how many physical properties you have, but it's all about the very one you are able to manage, the very one you are able to turn it into a data-driven asset. Thank you.
Thanks, Mr. Asare. I think if I can invite Victor to respond, followed by Mr. Madonsela.
Am I audible?
Yes, we can hear you.
Okay, can you see I wanted to answer it using the slide, one of my slides. Can you see
We
it?
don't see your screen yet. At the moment, we only see your profile picture.
Okay. Hold on to a moment.
Okay.
What? What? Yes, there we go. Yeah, mostly we talked about the traditional, which is the debt financing and the equity finances. And as we can see, there are other ones that we didn't touch, but I think maybe I was afraid because of the time, but I jumped into these ones, the summary of everything, and then I skipped this one. So we have the venture capital funds. So these funds, if you see that maybe your company is not doing well, so it's like as young people growing up, you can call other companies, other valuers around and say, guys, let's start one company and all of us, and then we invest in that company. And then that company can be the only one that will always get the funds from the bank, not putting risk in your individual company, right? And then we have what we call angel investors. Since you said something like when you don't know where to start, it's like a family or a friend startup capital. You start somewhere. You find out that there's someone or your friend in the valuation industry who's doing well. You can like go to him and say, whatever valuation that is troubling you, put me in, and then I help you out, and then we share the commission. That's one of the funding. It's like you are helping, at the same time the company that you are helping is funding you. So it's something like that. Every time until now, you can be able to secure your deal. And then we have like corporate funding. There are companies that are doing well. I see these companies like in our country, we have the diamond mining company. That company sponsors students who are doing well abroad from America, UK, China. If the person is doing well, they don't have any reason not to refuse funding you. I think you try and research if those companies are there, so that those companies they can look at your business plan. Are you really, like I said from my previous plan, these guys, you can see the slide, these guys, if you don't have the documents, the procedures, the structured, proper, they will never give you money, but the money is there for you to have. They will see that this guy is interested, and then they will like question you, test you. If they've give you a 5 million bucks, where are you going to be able to be stable when using that those funds? So, and then we have the a conditional ability whereby a third party guarantor legal promises to pay the principal debt if the borrower defaults. So in our country, we have the youngsters who are growing up. They will go to their father and say, "My father, may I borrow your land certificate, and I want to go build this double story for rentals, get the funds and build that." So they start from nothing. So these guys will go to their parents if they have a title deed and get the money from the bank, and they build. And imagine some of the money will be paying back to the bank, and I've seen the one of the project, they will tell you that there's no risk, because if you default, the bank will get your parents' land and auction it. At the same time, you have left with that multiple business that will also buy another new land for your family or something. So those are things that as young entrepreneurship, we have to properly risk and also put the fund management companies, so that those companies can help you manage the funds after you get the funds, not by saying I'll manage the funds on my own. Thank you very much.
Thank you so much. Thank you, Victor. Mr. Matanzela, please give us a South African perspective to the question. Is Diete still on the chat? Mr. Matanzela?
Yes, I'm still here. Sorry.
Okay.
Yeah, no,
earlier mistake. Yeah, there we go.
Yeah, no, I'm still here. Yeah, no, look, it's a very interesting question. A question that has always been asked by the majority in the country. And the guy that asked the question says he's from Zimbabwe. I know Zimbabwe is very interesting because whoever owns a property in Zimbabwe, they own it 100%. So there's no funding. So if you say you're a property investor in Zimbabwe, it means that that property is yours 100%. But in the country, I mean, we also have, venture capital. But like I said, I mean, if you see, I mean, the venture capital it's equity, right? It's somebody who comes in, you want 10 million, he comes in, he's got 10 million, he wants to buy a new idea, he'll put in the 10 million for a share. Perhaps you get a 10% share. But other than, I mean, venture capital, I mean, you have, I mean, our government, I think over the years has realized that the traditional banks are really expensive for people of color, and people of color do not afford to then can approach these banks and be able to get funding for investment simply because of the sweat equity that I spoke about. So you have institutions like your NHFCs, your TEF, that have got less stringent processes or less stricter processes where they are able to come in and assist in a way. But still, I mean, if you look at it, it's still the traditional way of funding. You know, it's either debt or equity. You know, so we don't really have in South Africa where it's you know, like you're asking, like a traditional way of doing it. It's either equity or debt. But also, if you look at it on the equity side, like you know, the venture capital, is that somebody can come in 100% and give you a sort of a share if they're buying into your idea, or you can approach institutions that are government funded, like I said, NHFCs and your TEF, that can perhaps lower the requirements. I mean, if you then have to come in on a senior debt of perhaps 70% in your traditional banks, they can go as low as 10%, 90%, where perhaps you don't even have to even approach some mezzanine funds and so forth. But a traditional way of doing it, perhaps, I mean, we have a lot of stokvels in the country. And I mean, our stokvels, I mean, the banks will tell you they bank billions of rands into the banks, the stokvels. It's really up to those individuals to then say that, do we then take this money that we have, come together and make something out of it, right? So it's really up to those individuals. But with institutions in the country, unfortunately, we don't really have those institutions that are really try to pick some of the young developers with ideas and take them to a certain level. That would only be your venture capital funders, which is really equity.
Sure. Thank you so much, Tsietsi, for that response. And I hope, Gasharai, that all our speakers responded in a way that is acceptable to yourself. And I love that, Tsietsi, you touched on stokvels. In South Africa, stokvels account for 50 billion rands annually in terms of how much they are interacting with at a banking level. It's just perhaps an opportunity then for everyone on the chat to look at innovative ways of modeling developmental finance. And perhaps not all of us will be property developers or property and asset managers, but a potential DFI could come up out of this chat. So I am cognizant that we are 1 minute to the end of this webinar. I will pop into the chat just to see if there are any questions. And there are none. So if there's nobody else who would like to engage our panel, allow me to officially conclude this webinar. We thank you so much for spending your Tuesday evening with us for 2 hours engaging on real estate finance and funding models. I would like to take this opportunity to thank our speakers. I would like to thank you, Victor, Kojo, and Tsietsi. And also a big thank you to the ACRE team for inviting me to moderate the session. It's been a delightful 2 days, and I wish you well for the rest of the week. I will be tuned in as a guest, at least, so the pressure will be lesser on my side. Thank you so much for allowing us to engage this evening, and we wish you well in all your entrepreneurial, professional, and all your endeavors in your respective career paths. To all our attendees and speakers, a wonderful evening to you all. Albert, I don't know if you still want to do a VOT from an ACRE perspective, but allow me to say good night, everybody on the call. Thank you so much for indulging me this evening.
All right.
Thank you very much.
Thank you, Zandile, for the fantastic session, or for leading us today. It's been a grateful, insightful day. And thank you to our speakers, Mr. Kojo, Tsietsi, and Bush Victor, for all the wonderful insight that you guys have presented today, and to our delegates who have engaged with today's program. Join us again tomorrow for the third day of the YEN webinars. Tomorrow we're tackling marketing, branding, and digital visibility, where we would be joined by another set of speakers, Lunza from Zambia, Atusai from Malawi, Mr. Jacobs from Nigeria, and finally our moderator, Siabonga Mshivi from South Africa. So join us tomorrow, same time, same place, for another enlightening session. Thank you, everyone. Have a lovely evening. Cheers.
Rock.
Right. Bye.
Thank you. Good night.
Thank you. Cheers.